Asset allocation is key to unlocking your investment potential. Whether you're a seasoned investor or just starting out, this video is going to break down the basics of asset allocation, making it easier to understand. Let's dive in. So, what is asset allocation and why is it important? It's all about diversifying your investments across different asset classes like stocks, bonds, cash, and real estate. The strategy aims to enhance your long-term success by spreading out your risk, and by investing in diverse assets, you can increase the likelihood that at least one is going to perform well. This diversification helps reduce overall risk. So the main idea behind asset allocation is that different assets have varying levels of risk and return potential. So by allocating your funds across various asset classes, you can strike a balance that matches your goals and risk tolerance. Plus, you can adjust your allocation over time to meet your evolving needs. So how does asset allocation work? Asset allocation divides your investment income among different assets with varying risk levels. For example, bonds are less risky but offer lower returns, while stocks can be more volatile but provide the potential for higher gains. Your choice of assets should align with your time horizon, risk tolerance, and desired retirement outcome. So if you're young and have time on your side, you can typically afford more risk. And as you get closer to retirement, it's wise to shift towards more stable assets. There are several strategies to maintain your assets. Strategic asset allocation involves choosing fixed percentages for different asset classes. Constant weight asset allocations available with certain mutual funds automatically rebalances your portfolio to maintain the desired balance. Tactical asset allocation lets you adjust your allocation based on short-term opportunities or challenges. The frequency of adjusting your asset mix varies based on your goals, risk tolerance, and market conditions. Generally, reviewing your portfolio annually is a good practice. Let's take a look at 4 investor profiles and their asset allocation examples. As an investor in her early 20s, Drew is likely just getting started in her career, so she's likely only able to contribute a small amount to her retirement savings. But thankfully, she has many years to ride out market fluctuations. An ideal asset mix for someone at this age may look like stocks 80% to 100% and bonds 0% to 20%. Drew may only be able to invest a small percentage of her income in retirement, as she's likely paying off student loans or earning a lower salary at the time. So she may want to devote some funds to higher risk, higher reward assets like individual stocks or real estate-based mutual funds like the Vanguard Real Estate ETF. A career-focused professional, Jackson is likelier to earn more income as he becomes more established in his chosen field of work. While he might not have student loans to pay down, he likely has other ongoing financial obligations to take care of, like a mortgage loan or a child's upcoming college education to fund. So considering these obligations, a suitable asset mix for Jackson could look like the following: stocks 70% to 90%, bonds 10% to 30%. Jackson is more likely to invest through his employer's 401k or other sponsored retirement accounts, which means that the best asset allocation strategy might vary depending on the brokerage firm that his company uses to invest. So if you're in your 30s, ask about any employer-sponsored 401k match programs to help you compound your savings without making additional cuts to your household budget. Abdullah is approaching his retirement age, but still working and contributing to his retirement account. As he gets closer to his golden years, Abdullah will want to start scaling back his risk exposure so that he can maintain his target retirement date. An example of an asset mix that might work for him could be the following: stocks 60% to 70%, bonds 30% to 40%, cash 0% to 10%. Depending on when you plan to retire and your goals, consider scaling down a portion of your investments to cash, as it's recommended for Abdullah. Scaling down a portion of investments to cash creates a risk that you'll lose money to inflation over time. Still, it may be safer for those with ongoing medical needs or other necessity requiring enhanced liquidity. Kimiko is a retiree who has recently said goodbye to the working world and hello to relaxing days on the beach. As she has spent her younger years putting money into volatile assets, Kimiko should now focus on retaining value and using her assets effectively as she enjoys retirement. Sample allocations for retirees like Kimiko might include the following percentage fund allocation: stocks 30% to 50%, bonds 50% to 70%, cash 30% to 50%. What is an asset allocation fund? An asset allocation fund does the diversification work for you. These funds allocate investments across different asset classes, providing you with instant diversification. They're a convenient option for those who want a hands-off approach to asset allocation. As you age, your financial situation changes, and so should your investment strategy. Regularly reassess your portfolio to ensure it aligns with your evolving goals and needs. There's no one size fits all approach, so make sure your asset allocation reflects your unique financial journey. Asset allocation is your tool to navigate the investment world and achieve your financial goals no matter where you are on your journey. So start your financial journey today, and remember, the best time to invest in your future is right now.